Hey, Jeff.
Hey, good morning.
Morning. How are you?
Good.
Wonderful. Actually, it's afternoon for us now.
Yeah.
Hannah, there's actually only a few more slides on that deck. I just looked at it. We covered the majority of it. Wait.
Hi guys.
Hey,
Hello. Hello. Hi Jeff. How are you?
Hi, good afternoon. Good to see you.
All right. We'll give it a few minutes to see who's jumping on.
Hannah, did you hear about the presentation? There's really only a few more slides on there that we haven't covered already.
Yep. But it's good stuff though.
Oh yeah, it is good stuff. Yeah.
Let me see if Maritz is jumping on. You
I
want
know.
to see
Veron-
Veronica jump?
yeah, she texted me and said she was going to get on. I know June is working, so she won't.
Okay. All right. Well, let's see if they jump on. If not, Jeff, we could kind of do something different because we were gonna do a part two to what we did last week, but you weren't on. So I think we can just kind of customize towards you today. Maybe deep dive into, we've been going through different insurance strategies. And we kind of like did a little bit of a series where we started off with term insurance.
Okay.
We taught how term insurance works and then got into whole life and then got into the IUL. So how much do you know about term insurance right now?
Term insurance, I have a policy. It doesn't build cash value. It's good for a certain amount of time. Depending on the policy, you can roll it into a whole life policy when you're done, depending on the policy. Yeah, I don't know. That's the basics of it. It's a specified amount over a certain amount of time.
Okay. And what company is your term insurance through again? Remind us.
Um, I would have Pekin.
Pekin?
Yes.
Oh, I've never heard of that company before.
All right.
That's a new one. All right. So the reason I ask is that when we do use term insurance, a lot of times we're thinking of the future. So kind of like what you were saying when it comes to conversions. And the question always becomes, what kind of a policy can it convert to?
Yeah.
So there are some companies that they might have really good term rates. Like for instance, Banner has really good term rates, but their only options to convert would be like a whole life policy. Um, so I'd have to do a little research into Pekin. I've actually literally never heard of that.
Me neither.
Uh,
When we got the policy, my wife's uncle owned the agency. So that's what we got.
okay, awesome. So yeah, so the idea behind term is that it's going to be cheap for a certain time period. So you can choose level, you could also choose increasing, but generally people have a term that's level. So let's just say that they choose a $500,000 policy for 10 years. So their premium will be level for that 10 years. So let's call it $50 a month for 10 years. But then what happens in year 11 is that premium just pops up really high. And so the idea is it's generally going to be way too high and it doesn't make any sense because it increases every single year. So most people are going to drop that policy. So what typically happens is if there's like a need, like, hey, I need coverage just for the next 10 years and that's it, and then I don't care about life insurance coverage, then that could work. Sometimes someone might say, I have this policy for 15 years, and then I'm done with it, 20 years, 30 years. The ones that are the toughest are the 30-year terms, because you're going to have a low rate for 30 years, and then you're going to have a massive jump at year 31. And so we kind of did this on one of the calls where we said, go to Google and type in what percentage of term policies ever pay out a death benefit. And it's literally like 1, 2, maybe 3% of
Mhm.
term policies pay out. So the idea behind it is you're renting that policy. So very similar to when you're making a decision about buying a house or renting a house. So the interesting thing about home ownership is that most people have a pretty good understanding as to if they're going to rent a home or they're going to buy a home, what are the pluses and minuses? And obviously a benefit of renting a home is that you're going to pay less. So that is the benefit. And so the idea is, well, if I rent a home and I invest the difference, then over time I can have a massive amount of wealth. But that property is not yours. It never becomes yours. And in fact, at any given time, the property owner can say, hey, we're going to sell the house and you got to go find a new place to live. And it may or may not be at an ideal time in your life where you want to move. So when you're buying a house, the idea is that you're going to spend more money. You know you're paying more money to buy a house. You're making a down payment. You're probably going to have higher monthly payments. But the idea behind purchasing a home is that now you're building equity. So part of your monthly payment is actually paying down that loan so that you have that ownership, but also the home can go up in value. So over a 10 or 20 or 30-year period that you own that home, you're paying down your debt and you have an asset. So with insurance, it's a similar concept of whether you're going to rent the coverage or whether you want to own the coverage forever. If you want to own the coverage forever, you know you're paying more. But again, that policy can also build equity, which is now yours. Does that make sense?
Yes.
So I'm going to go the flip chart because we got a bunch of us on. So I think all of you guys were on last week. And I'm going to share some slides. And then we're going to have Brett go through some questions and answers with you guys. And the goal is that you guys just get really super educated on insurance. All right. So last week we talked about how to use your cash value. We talked about the 4 core benefits: rate of return, control, risk, and taxes. We talked about using a max funded cash value life insurance policy, permanent life insurance, living benefits, tax-free distribution and inheritance, legal protections, no age distribution restrictions, zero floor security, secure compound interest. Okay, we got through different reasons that people are going to use the insurance: key man, buy, sell, using it as a tax-free business bank. We talked a little bit about how it works, how the general fund works, how you could access your money. We talked about, exactly how the policy works in terms of how they're investing your money. We talked about the caps and the floor with an indexed universal life. We talked about the indexing strategy compared to being in the market that goes down, up, down, up, down, up, versus no growth when the market goes down, but you got that zero. So zero is your hero. But then when the market goes up, you can capture that upside, and then stability when it goes down, and up, and then stable, and then up, right? So when you take a look at these two strategies, this is why, again, this does not include the fees. So you have to be very careful not to just assume you're going to have more money, because you are also paying fees. But the actual indexing strategy, this is how that works. Okay, so how does cash value life insurance work? So you have two benefits. You have the death benefit, which is what you're purchasing. So the reason you're paying all these fees is because you're getting a benefit. So let's think about this. If you were going to put away $1,000 a month into the life insurance policy, and they're going to pull out a fee for that. So what the school of thought is, well, if I just take my money and I just invest it on its own, I'm not going to have such high fees. But let's think through that for a second. So if I put $1,000 into an investment and I pass away, what does my family get? Anybody? Anybody?
Well, you hope that $1,000.
Right. If you make a premium to the life insurance company of $1,000 and you die, what does your family receive? Could be $500,000.
Sure.
Could be $1 million. So is there a difference, just a fundamental difference of if you're looking at this strictly from an investment standpoint, you really can't, because the benefit for that premium going in the life insurance policy is you have a death benefit. Okay. Now, the other benefits that this has is you can have a long-term care rider on there. You can have chronic or critical illness protection on this. So what that means is that if you cannot perform 2 out of the 6 activities of daily living, and you need to be in a nursing home or you need to have a full-time nurse at your home, this will pay you out a benefit. And the sad thing is that you never know when that's going to happen. And, we just went through this with my mother-in-law, and she was bouncing around, healthy as can be, no health issues, no diagnosis. She was watching our kids, all the time. And then all of a sudden, literally over the summertime in June, she started getting sick. July, she was admitted in the hospital, and we had to put her into a facility in August, and that facility cost a lot of money. So literally between the months of June to August, her whole world changed. And then she passed away late August. And so the only benefit to that was that we didn't have to continue to pay $15,000 a month for a facility. But she could have made it another 2 years at $15,000 a month in a facility, plus having to pay her mortgage, plus having to pay all of her other expenses as well, plus medical bills. So people don't really think about the effect of what happens if you need long-term care. What happens if you're in a massive car crash and you're not able to work and you're in a facility, or you have to have 24-hour care. June, you have a question?
I do. Sorry, I should turn my camera on. So thanks for explaining that. Question is in regards to what is the difference between long-term care and chronic illness on the standards? Because you said 2 ADLs are for long-term care or chronic illness.
So long-term care is the standard 2 out of 6 ADLs. The chronic and critical, there's like a test that they use is it going to be a chronic illness? Meaning that, is this something that's going to go on for a long period of time? And a critical illness, it could be something that, you have a massive heart attack, and without 24-hour care, you're not going to survive. So critical could be more of an immediate, chronic can be more like Alzheimer's, right? So
Okay, sure.
yeah, so the way that they pay out is also different. With the standard long-term care, it's going to be typically 2 to 4% of the death benefit. So if you have $1 million death benefit, you can choose 2% or 4%. Now the difference is 2% would give you $20,000 a month until your money runs out. 4% would give you $40,000 a month till your money runs out. Okay. But there also is a HIPAA regulation that will give you the maximum that the policy can pay out per HIPAA. But if you had $1 million and you were pulling out 40 grand a month, you'd run out of money very fast. So most people will just choose that 2% option. The critical or the chronic will typically be like a lump sum. So if you have $1 million death benefit, they're going to assess what this is, and they might give you a benefit of $200,000 or $500,000. Okay, so definitely different. And it's also different in terms of qualifications. It's a lot easier to qualify for the critical or chronic than it is for the standard LTC. That make sense?
Yes, thank you. Can you get both? Or is it going to be too expensive of a premium with both of them?
I think that you could choose both. That's actually a good question. Brett, you think no? So I know when you're applying for the policy. Huh?
Most illustration software won't let you put both on there.
Okay.
It's one or the other.
Okay. So
Okay.
yeah, that's, I mean, I'll definitely have to check because they do give you both options. I don't know if you can click both. I've never thought to click both. So the biggest difference is that for most carriers, there's no extra charge for the critical or chronic illness. There's an extra charge for the long-term care. So, you know, you're paying for that to have that on your policy. Now it's very inexpensive, but it's still going to have an effect of your cash value because now you're paying more in fees. Where the chronic or critical will only start charging you fees once you take that benefit. Does that make sense?
Yes.
So,
Thank you.
yeah. So most of the time, it depends on what you're buying the policy for. If you're really buying the policy because you really, you love the fact that there's life insurance, but you really want to max out your cash value, you want your fees to be low as possible. So the way you're going to structure the, was that?
Real quick, sorry, I just looked and it literally says error, critical illness rider is not available with long-term care. Long-term care is not available with chronic, accidental death, children rider, waiver, GIR, AIR, or long-term care.
Okay. So yeah, so you pick one or the other, but the way that I do this is that if the client really wants to maximize that cash value, and we'll use that same $1,000 a month premium. And if my goal is really like they're younger, we're just trying to max out this cash value, I will usually go with a chronic or critical illness rider. But if someone is using this policy and they're really thinking long-term care is very important to me, that is like the driving force of getting the policy, then I'll use the standard LTC option. So as you guys learn this, and remember, like part of what we're doing is we're taking you through the illustration software and we're showing you how to actually build a policy, how to actually customize a policy. So when I first got my license, one of the things that I did was I would pull up the illustration software and I would sit on that for hours and hours and hours and I would just play with it. So if I put in $200 a month, what would I have by age 65? If I did 500 a month, if I did 1,000 a month, and I still do that. Like when I'm bored, I'll just kind of sit there and like, I'll just play with different options. And I want to show if I retire at 65, if I retire at 70, and I start taking this income, what's it going to look like? So it kind of also starts to sell you the dream, meaning that when I first got my first policy, I was totally broke. And even that $200 premium was a stretch for me because I was paycheck to paycheck. But if you're putting in $200 a month, it'll tell you by age 65, this is how much you'll have. This is how much income you can take in retirement. So when I raised it to 500 or 1,000, I started thinking, wow, I need to get myself in a position where I can put away 1,000 a month. And then I started thinking even bigger. And I was like, what if I could start putting away 10,000 a month, right? So that when you play with these numbers, you can start to kind of have a lot of fun and just start stretching your own vision as to how much wealth do you want to accumulate in something like this and really understand how it works. So this is probably one of my favorite slides. And there was a book that was actually written, and he basically talks about how this policy is like almost like a pocket knife, because it has so many different benefits. So like a pocket knife, literally, you know, you can use it for so many different things. And this product, has a flexible premium. So it's not like your mortgage payment where you commit to $3,000 a month and there's no flexibility. You're just at $3,000 a month. So you might start this at $3,000 a month, and then a few months later, you need to lower it to 2,000 a month or 1,000 a month. Or maybe you want to go from 3,000 to 4,000 or 5,000. There's flexibility. Now there's rules. And when you understand the policy, you'll understand the minimums and the maximums, but it's a flexible premium. That makes sense? But on one hand, you have this protection side. So you have permanent life insurance. You have a tax-free death benefit. You bypass probate with the benefit. You have multiple settlement options, meaning that if you want a lump sum, you could have a lump sum. If you want payments given to your beneficiaries, you can choose payments. Because some of you might think, well, gosh, I don't want my kids to get $1 million and then go blow it. So maybe you want them to get $5,000 or $10,000 a month. You can establish that in your policy. Okay. Now, living benefits, we just went through that. Critical, chronic, long-term care, terminal. Terminal is if you have less than 12 months to live and a doctor signs something, they will give you a big portion of your policy death benefit while you're alive to maybe do some experimental, treatments, or to live life to the max if you know you only have a year left to live. So these are all benefits that are on the protection side of the policy. But now on the savings side of the policy, right, you're earning interest on your money based on market indexes. You have downside market protection. You have liquidity. You could withdraw money from the policy. You could take loans against the policy, okay? You also have tax advantages on your money. So you're using after-tax contributions. You have tax-free accumulation. You have tax-free distributions through your policy loans. There's no premature distribution penalty and no minimum required distribution. So let me explain that to you because that's a very big deal. So most people use the IRA concept because they don't want to have taxes every single year. They want the tax deferral. But what happens is that if you pull your money out pre-59.5, you're subject to penalties. That happened to my parents. My parents had their money in an IRA. They were doing great. And at age 55, the real estate market dropped. The stock market dropped. Their business started drying up. And so they had nowhere else to go but their IRA. And so they had to start withdrawing from their IRA and paying massive penalties and taxes. So when you understand how this works, if you have an IRA and let's just say they had $500,000 and they were taking out $100,000 to help pay their bills, well, now they're going to potentially pay 30% taxes plus a 10% penalty. So they were losing 40% just to pay penalties and taxes on that $100,000. Does that make sense? And you do that a couple of years in a row and they were out of money. And within a declining market and you're pulling out that money, that becomes an absolute disaster. So these policies don't have a 59.5 rule. If you need to take withdrawals or loans against it, you could take, if you bought a policy when you're 15 years old and you're 30 and you want to take money out, no problem. Okay. And there's also no required minimum distribution, meaning that a lot of people who use these IRA concepts, when they realize the tax hit that they're going to take, they try to defer their withdrawals as far as possible. And I get a lot of clients that are like, I don't want to pay the taxes. Like I still have an income. I'm getting Social Security. I have real estate income. I don't want to make withdrawals from the IRA. But by age 73, they have to because the IRS wants their tax money. That makes sense? So this product allows you to do all that. And in some states, there's creditor protection. So that's some states, not my state. Okay. So if you take a look at how this works, okay, you have a maximum that you could put in, and you have a minimum that you could put in. Okay. And what happens over time, you start putting your dollars into this account. So in the in the accumulation phase, you're putting your money in, okay? And so over time, your cash value is going to increase. And this is showing a level death benefit where the death benefit does not increase. But what happens is that that cash that you're putting in becomes the majority of that policy. Okay. So I don't think we're going to be getting into like level or increasing. I've got 2 more minutes. I'm going to pass it to Brett. But the idea is you're putting money in the accumulation phase, and in the distribution phase, you're able to start taking that money out. Does that make sense? How many more slides do I have? 1, 2, 3, 4, 5.
Yeah, I
Okay.
can do the rest. The rest is pretty simple.
Okay. Did you have the slideshow?
Yeah, I've got
Do
it.
you have it? Okay. You want to share your screen?
Yep, let's do it. I am not allowed to. You want to make me co-host?
Let me see if I can.
Oh, it says the other, well, I can't do it while the other participants, so unshare
Ah.
yours.
Okay.
There we go. So let's actually do this. So this is a little bit clearer picture of what we were looking at just a second ago. Were there any actual questions there? No? Okay, she nailed it. So on this one's actually showing the full path of it. So money comes in. You do have exactly what she was saying. The money actually is growing. You have the level death benefit there. That's not changing. But actually what it's showing here is as you get further along in the policy, the fees get less. So your more money is actually going to the actual cash value there. Does that make sense? So these are front-loaded policies, meaning the fees are a lot heavier in the beginning. And then as the policy progresses and matures, it's a lot less. Does that make sense to everybody? Yeah. All right, now I'm nailing it. So these are the actual IRS codes that allow for tax-free accumulation. So 72E allows for the money to grow tax deferred. 7702 allows for you to access the money tax-free. And 101A allows you to transfer the money tax-free. So, oh, yes, Veronica.
I think I already know the answer to this question, but I just want to confirm. So all that cash value, if something happens to me, my children would get cash value and the policy, whatever it is for, right?
It depends on how it's set up. So truthfully, it depends on how it's set up. So as you saw or heard Hannah say a moment ago, this one's set up with a level death benefit. So if you were to pass away with a level death benefit, let's say you had a $500,000 death benefit and $100,000 in cash, your beneficiaries would get the 500,000 and not the 100,000 in cash. So it's actually one or the other when it comes to the level. That's designed to be used while you're living. And then, but increasing as, let's say you start out with a 500 death benefit, then increasing when you accumulate 100,000, it actually says 100,000 and 600,000 death benefit. So if you pass away, the 600,000 is now the new beneficiary, what the beneficiaries get.
Okay.
Does that properly answer your question? Okay. Yep. Anybody else need any clarity on that? No? Okay. So like I said, this is just a page literally describing the IRS tax codes. TEFRA and DEFRA, this is I know I've discussed this before on these calls, but you know, we've all slept since then. So this is discussing the corridor. And what this means is the IRS allows for a certain ratio of death benefit to premium, meaning I'm not allowed to take $1 million and go buy a $10,000 life insurance and stuff it in there and grow it tax free. They're like, whoa, 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 that's tax fraud. That's tax evasion. You can't do that. But what you can do is you can stay within their corridor of a certain amount of death benefit to cash value. And as long as you stay within this and don't fund it outside of this corridor that they have, then it's all tax free or tax deferred. And now if you do fund it over that, which most companies won't let you, but if you did, then it's going to turn into what's called a modified endowment contract. And now everything is taxable. So, and then Tamara is another tax code that requires a minimum of 5 to 7 years of actual funding. You can actually set it up to where you max fund the policy in 7 years and you never actually fund it again. So if that's, you know, a lot of people have just a big lump sum. Cool. Let's put it all in there. Never fund it again. You've got life insurance for the rest of your life. The cash value is growing. You could take it out tax deferred. It's liquid. Yeah, lots of benefits there. So accessing your cash value. All right. Sorry, all these boxes are on my screen. So obviously everybody knows you can withdraw up to the premiums that you put in tax free, your cost basis. That's on everything, any sort of investment, your stock account, everything like that. You're not going to pay taxes twice on the same dollar. So, but anything growth is where you're actually taking loans. So it's not the same as borrowing from the bank, as you can see there. There's multiple different ways that you can do loans on this. There's the participating loan and then the non-participating loan. So the participating loan, I'm going to explain in this way. Say I have $500,000. Oh, Veronica, there's another question there. Or is that hand still raised? I don't know. I don't know what's happening. Okay, I think her hand's still raised. Okay, so the participating loan. Let's say, just as an example, you have 500,000 in cash value. You can take up to 90% of that as a loan. So I don't know, let's say that's, what is that, 450,000? So if I take 450,000, I can go, and me personally, I like real estate. I'm gonna go and buy $450,000 of real estate, turn them into Airbnbs, get 10, 15% on that. With the participating loan, the company is going to charge me 4 to maybe 8%. I know it says 5 to 8, but I've seen 4. I've actually seen 3. So let's call it 3 to 8. They're going to charge me 3 to 8% interest on that while I'm paying it back. If I'm getting 12 over here, I'm paying 3, but then the actual policy's paying me, let's say 7, 8, 9%. And it's a positive arbitrage there. So I'm getting the 12 over here, the 7% here, 19, I'm paying 3 to pay it back. It's a win-win-win. So that one, when I take the 450 out, they still compound the entire 500 as if I never removed the money. Okay, does that make sense to everybody? Yeah, wonderful. Then there's the non-participating loan, where this one is typically a wash loan where they might charge you 1 to 2% interest. However, they also credit you 1 to 2%, the same amount. So they're not actually doing anything. But on this one, if I had 500 and I took 450 out, I'm now compounding 50. I'm no longer compounding 500. It actually removes it from it. And then there's the traditional bank loan that you can actually collateralize your policy on and get whatever rates that they want. So this is just an example of, oh, June, you got a question?
Yes, it's just a quick one. So why would anyone want the non-participating loan if you're not compounding? Do you
Hannah,
get to choose? I guess. I guess you get to choose.
you get to choose. Absolutely. Yeah.
Okay.
Hannah likes the, me personally, I'm with you. Charge me interest and compound the whole thing. But Hannah, for instance, likes the non-participating because she doesn't have to pay it back. And it doesn't come out. I mean, it's just she can pay it back if she wants. She's not getting charged interest. She likes 0% risk and interest on anything that she does. And she's probably using that if she's doing it, she's probably using it for, I don't know, pay off her house or something like that. And she's not actually buying an asset. But if you're going to be going and buying an asset, the participating loans are awesome. So you have either or.
Okay, thank you.
Yep. Did that answer your question properly?
Yes, I guess I didn't real. I must have missed when you said that the non-participating you have to pay them back. I didn't miss
You
that
don't
part.
have to. It can come out of the
Okay.
death benefit. It can, if you don't pay it back, it can come straight out of the death benefit. If you pass away, you know, if it's
Okay.
yeah, it'll come out of that, or you can just pay the interest each year on it. So yeah,
Okay.
you have the options there. Maritza, I saw you raised your hand
Yes.
and then took it down. I don't know.
Yeah, just to kind of add on to June's, so with the participating loan, you do have to pay it back, or no, that's something that you have the option to, and it'll just come out of the death benefit as well.
Yep, you have the option.
Okay, got it.
Yeah,
Got
you can if you want. Most people do pay it back because they set the death benefit in a way that I want my family to get 500,000, and if you take a loan out of it, you get
Gotcha.
500 minus. But so most people do. But if you're like, the heck with them, I don't care, I don't want to pay it back, that's fine. They're just going to get the death benefit minus whatever you still have outstanding in a loan. Answer your question? No, okay. So this is an example of just the fixed loan, non-participating cash value, have $1 million. You take out 5%. In this example, they're charging you 2.25 and giving you a 2% credit. So most policies are going to give you a 1-to-1 interest and credit, but some don't. So this one on the non-participating loan would charge you 0.25. Then on the index strategy, you're making 7 in this example on this slide. So it's still, you know, a good deal. You're paying 0.25, you're getting 7, you're getting 6.75, you know, net there. And then on the participating loan, this example is you're getting charged 4.4%. There is no actual credit, so it's just a 4.4% interest rate. You're still making 7 on this, so you are still getting a 2.6% positive. And then hopefully you take that 500 and you go out and you buy some sort of cash flowing asset. And yeah, you win all around. You get to use the same, and then also you're still compounding the full $1 million. So that one's essentially using the same dollar twice. Then bank loan, you get whatever the bank actually charges you. You're using your policy as collateral. Your index strategy is still compounding. Nothing's come out of it. So yeah, that's also a very good option as well. You can collateralize these loans. So here are just some methods of people that typically use their cash value for. You know, a lot of people, there's a big craze, you know, become your own bank. And you know, that's kind of what a lot of people think of as this right here, the participating loan, or even the fixed loans. You know, you can take it out, put it back in there, pay it back at a super low interest rate, no problem. You're still growing. So that's the whole become your own bank concept that is all over social media now. That's what this means. It is some diversification, and it is a safe and secure place to grow your money. You're never going to lose in an IUL. You can't. What's the catch? So with everything, there is a catch. And it's not really a catch, obviously. I mean, you do have surrender charges. These are long-term policies. So most policies are 10 years, some are 15, and just depends on the carrier. But there is a surrender charge on there, and you typically have a percentage of your actual cash accumulation available to you. So if you surrender the policy within the first 10 or 15 years, then you're not walking away with all of the cash value in there. So there is a surrender charge just because it is designed to be a long-term play. And then you also have the cost of insurance. You know, insurance isn't cheap. It's not nothing. And however, these policies are really designed as insurance policies. So a lot of people sell them as just straight investments. You know, it can be, in that it does grow your money. There's a lot of benefits there, but at the end of the day, it is an insurance policy. So that cost of insurance is definitely a consideration. And then it must be designed correctly. There's so many ways to design these policies, as you know, we've shown briefly over the past few weeks, and it's extremely easy to design it for the agent or design it for the client, if that makes sense. It's very, very easy to hit one button and increase the commissionable items on it for the agent and decrease the actual value of the policy. But then it's just as easy to turn it around and do what's right for the client and make it an amazing product and take less commission. So that's what we mean by it must be designed correctly for it to be a true value asset. And we'll show you all of that as well, to show you what not to do. Don't be dirtbags. And that's basically what it boils down to. Take care of the client, they take care of you. This is a referral-based industry. So let's see. So how safe are life insurance companies? With us, we only use A-rated companies. All right, we only work with the highest rated companies, and that's from Standard & Poor's. And so if they actually lose their A rating and drop to a B, we take them off our platform. All the companies that we have, they have a track record, longevity, over 100 years. So the majority of the companies that we work with have over 100 years of industry, being in business. So they are, you know, they're solid. And yeah, so another great thing about it is with a bank, if you go and give your money to the bank, they're required, and I don't know the exact number, so don't quote me here, but I can give a pretty close ratio. They're required to have like one for every dollar they've lent, like $1 for every $3 or $4 that they've lent out, in case people actually come and try and take their money back and pull it out. That's what happened to Silicon Valley. They didn't actually have enough money in reserves to take care of all the withdrawals that were happening. They're not required to have a 1-to-1. An insurance company is actually 1-to-2. An insurance company actually has $2 on the books for every dollar that is outstanding in death benefit. And so like they are solid. FDIC, it's failed. Insurance companies don't. There's been a few that do, but they're rare. They're super rare. They're required to have a much higher percentage of money on hand to cover all the outstanding stuff. So they're very, very secure. And then on top of that, we only use the A-rated companies. And these slides, I mean, these go into just a little bit more advanced concepts of you can use it for key person, for business stuff, and actually insure key key employees. But that's pretty much the end of the slideshow there. What questions do we have, if any? I know just every single person on this call is actually either licensed or going through their classes. Are there any questions on that? I know Maritza just finished her classes. Uh-oh.
Yeah, I just think I need to study the information because it's a lot of information in those classes.
It is, yeah. Have you started taking the practice tests yet?
No, I'm about to.
Okay.
I was
Yeah.
running through my notes.
Oh, nice. Okay. Yeah. Once you start taking the practice test, and I mean, if you're getting 80s, 85s on those, go take the test. Like you're fine. So
Okay, well then that makes me feel better because I have, so that's good.
yeah. If you're getting an 80, 85 on those practice tests, they're pretty much the same exact questions. In fact, Excel designs it to where they want you getting to a point to where you're like, oh, the first 3 words, oh, I know the answer to this. I remember this question, because the majority of them are the same questions that are on the actual test. So easy enough.
Good to know.
Yeah. So what other questions? Are there any questions on anything we talked about today, or that we have talked about in the past few weeks?
I don't have a question, but I would love to see the slides. It was one of the few last ones where you talked about the loan options, the different loan options.
Yeah, let's do that.
Because I love that subject. I just love that.
Yeah. Tell me when to stop, because I don't know which one you're talking about. So
Okay.
maybe. Yep, there we go.
Hold on. Yeah.
Oh.
Go back. One, I think. Yes. Accessing cash value. So basically it was 3 options that we talked about.
Yeah, we talked about the non-participating loan, the participation loan, and then the synthetic bank loan, where you use your policy as a collateral.
So for someone that really wants to become your own bank, basically, which one do you recommend for something like that?
Well, the whole concept of becoming your own bank is going out and buying assets with the money that are also cash flowing, and then establishing multiple cash flow assets. So with that, I would do the participation loan, because that way it continues to grow over here, no matter, even though you took the money out, it's continuing to grow. And since it's continuing to grow as if the money never left, you're able to essentially use that same dollar twice, because you can take it out, go use it over here, create a cash flowing asset over here, while that same dollar is now compounding in multiple directions. And then you go back and forth and just pay it back, grow this back, pay it back, go get another asset, pay it back, grow it big, get another asset. And then you can technically, if you buy real estate, you can do a HELOC over on your real estate. Now you're technically using that same dollar 3 times. So that's really the concept of become your own bank. And so with that, I prefer the participation loan. Yes, they charge you interest on it, but as long as it's still growing at a higher rate on the index, and you're going and buying cash flowing assets, it's a win-win-win.
I love that. So most people go to real estate for assets, purchase real estate.
I mean, that's what I like to do. But we have a buddy who's about to go buy a Rolls Royce with it. So you have no stipulations. You can literally buy whatever it is you want. I would suggest buying some sort of cash flowing asset with it.
Absolutely.
And I think Kiana would probably suggest the same. I think that's probably where she would go as well. But it is 100% your discretion.
Thanks, Brett.
Yep. June?
Thanks. So I'm just gonna piggyback on the question that Veronica was asking about the loan. So I remember hearing once Hannah mentioning that the loan, there was one company that after 6 years, the loan dropped to like 0. That was not a participating loan, that was a non-participating loan.
Yeah, that's this one. So in the first like few years, the first like 6 years, they might charge you like 1 or 2% and not credit you. But then after that, whatever they're charging you, they credit you as well. So so there's, and when she said there's no interest, which what she probably should have said was it's a wash. It's a wash loan. And that's what this slide here means is they might be charging you 2%, but they're also crediting you 2%. So to you, there's nothing.
Got it. Okay. And the participating loans always gonna have one. It doesn't matter after 5, 10 years. It's still the same 4.4%.
Some policies credit you on that, but the index is, but you're usually still paying something. So and it's usually like this example says 4.4 and it doesn't have a credit like on this one. Like this one says negative 2.25 plus 2.
Yeah.
I know Nationwide's VUL will charge you 4 and credit you 3. So
Okay.
that's in all years. So it really depends on the carrier. But for these slides, since they're not carrier specific, we're just kind of giving generic.
Got it. Thank you.
Of course. What else? Anything? June's over saving lives, it looks like.
Trying to.
I love it. Anything else? If not, I mean, I want to respect you all's time. So if we've nailed it and there's no other questions, then we can say goodbye for today. But I want to make sure we answer everything and add value. So okay. Well, then you all have an amazing day.
Thank you. Bye, everyone.
Bye, guys.
Thank you, you too. Bye-bye.
Thank you, Brad. Thank you, Hannah. Bye, everyone.
Bye.